Well, stocks on Wall Street had their best week in 6 last week after the trade truce between the US and China saw the bulls get the bit between their teeth once more amid a mixed bag of US economic data, although that didn't stop the dollar gaining for a fourth week in a row. New week gets underway with focus on the US credit ratings downgrade by Moody's towards the back end of last week, but with a much lighter data docket ahead this week, it leaves trade headlines and geopolitical developments squarely in focus for market participants. Nonetheless, plenty for myself and Ryan Littlestone to discuss on the trade-off this week. So without further ado, let's crack on with the show. So plenty going on in the financial markets. Joining me as always to try and make sense of everything that's going on is my good friend Ryan Littlestone from Forexflow Live and Forex Analytics. And Ryan, it seems like the sky is falling in. Armageddon is upon us. The US economy is about to implode. Well, at least that's the vibe you would get from reading through my Twitter feed this morning. I mean, personally, I'm looking at this ratings downgrade and saying, what the hell took Moody's so long? You're just stating the obvious here, guys.
Yeah, well, I'm waiting for you to deliver my Pepperstone signed tin hat, so I can put it on and protect myself from all the falling debris that's happening at the moment. Yeah, we'll talk about that, I'm sure, in more detail shortly. But yeah, the sky's falling in apparently.
Well, apparently, I mean, it certainly hasn't here in London, and I don't think it is going to in the United States either. To be honest, the credit worthiness of the US does not depend on whatever three letters the rating agencies want to give it. It's basically because it's got the global reserve currency, and I don't think that's going to be going anywhere anytime soon. As you said, we can get into that and everything else in the rest of the show. So let's crack on with Topical Thunder. Right, we'll talk about the US in a second, but I want to talk about the UK first because it's been a busy couple of weeks for data here in the United Kingdom. Last week, we had a few notable releases. We had labour market data for March, which showed headline unemployment rising to 4.5%, which is the highest since the middle of 2021, and earnings growth ticking a little bit lower, although, of course, we do need to take that with a little bit of pinch of salt, given the well-known issues with the ONS and their data quality and data collection methods. We also had payrolls data for April. According to HMRC, employment fell by about 30-odd thousand last month, which is the fifth month in the last 6 where we've seen a decline in employment of that sort of magnitude. Now, I've got to say, Catherine Mann at the Bank of England trying to claim that the labour market is resilient amid that data. I mean, what the hell is she looking at to come to that conclusion? I would love to know. We did, though, also have GDP out of the UK last week, which was actually a little bit better than expected, with the economy growing by 0.7% on a quarter-on-quarter basis. But before anyone gets too excited about that, there was a lot of activity being pulled forward into Q1, firstly ahead of the national insurance changes that went into place at the start of April, and of course, a result of a surge in exports amid all of this tariff front running. To give a bit of context on that, exports to the US, they rose by 16% quarter on quarter in the first 3 months of the year, which is the biggest quarterly rise since the middle of 2022. So quite clear where that boost to economic growth has come from. In terms of this week, it is another busy week. We have CPI figures due on Wednesday. Headline inflation seen rising to 3.3 from a prior 2.6%, with services seen rising to 4.9 from a prior 4.7%. It must be said that a lot of this is due to the one-off price hikes that we always see at the start of April, things like energy bills, water bills and such like. The start of the fiscal year sees a whole host of annual price increases, and you would expect this to be the start, if not the peak, of this temporary hump in inflation that we're going to see over the summer. Moving into Thursday, we have the latest flash PMI figures. All of the indices were at multi-month lows in April. We'll probably see a little bit of a rebound, but we'll also likely see the composite output gauge remain below 50, implying a second straight month of contraction in the economy and reinforcing the idea that that Q1 GDP number is probably as good as it's going to get from here on in. And then on Friday, we have the latest retail sales report. Now, retail sales have risen for 3 months in a row here in the UK, and following the usual rule of thumb with the UK consumer, the sun was out for most of April, so the data will probably be all right for that month as well. In terms of the Policy outlook, I think it's unlikely that any of this data is going to materially alter the balance of risks for the BOE. It's likely that they're now on hold until August when they deliver the next 25 basis point cuts. But also, amid all of this, it's got to be said that the pound really couldn't care less. We're just sort of plodding along either side of the 133 handle. We've had a little bit of a push up towards 134 in cable early doors this morning amid some dollar weakness. But to be completely honest, sterling, as with most of FX at the moment, is not trading on the back of this data, despite the deluge of releases that we keep on getting.
Yeah, absolutely. And I don't know. I don't think the jobs market is as bad, perhaps, as maybe you make out or some other people make out. Yeah, we're seeing a little bit of weakness here, but apart from the US, who isn't? Unemployment isn't the greatest in a few countries, but nothing yet is rolling over. So we're in a similar position. And yeah, some of the numbers have been better. GDP's been a bit better, whichever way you look at it. You'd rather have plus 0.7 than minus 0.7, however it comes. So it is important that we keep that run going. If we do see a complete reversal, then all bets are off. But yeah, important data this week. That CPI data, quite a large jump, isn't it, expected on Wednesday? And I think if it doesn't come in as hot as expected, then I think we're going to see maybe a little bit of a shift in those rate expectations for the Bank of England, maybe getting a little bit more dovish as terms of when the next cut does come.
Yeah, potentially. Although I think the problem the BOE have got is they've now set such a high bar to deliver another cut in, well, basically a month's time, because obviously you had two holdouts against a 25 basis point cut last time out. For most of those who voted for the 25 basis point cut, it was a close call, according to the MPC minutes. And they stuck with this idea of gradual and careful easing, which everyone has probably rightly interpreted to be quarterly rate cuts. So, yeah, I can see the argument for the market getting a little bit more dovish, but I'm not sure that the BOE will actually end up living up to those expectations if we suddenly end up pricing in, any decent chance of a cut in June.
Then this is the BOE, and they could just as easily cut next meeting and make up an excuse as why they've done so after being cautious about not doing so the meeting before. So, might as well toss a coin, mate.
Mate, to be honest, this being the BOE, they could cut next week in an unscheduled meeting, knowing them. I mean, as you say, all bets are off. And certainly that flipping of a coin seems to be how Catherine Mann is making policy at the moment. 50 basis point cut in February, unchanged in May. How the hell is she coming to that conclusion? Anyway, we best move on. Now, I've got a bit of a bone to pick with you here, mate. I was hoping, 2019, 2020, we'd put this one to bed. We'd never have to hear of it again. And, now you're giving me PTSD from all those long nights watching Parliament TV, seeing meaningful vote after meaningful vote come to no conclusion whatsoever. Why on earth do we want to talk about Brexit again?
Well, you and me both, mate. I mean, I felt like booking myself in for a counselling session when this all started up again myself. But here we are. We can't ignore it. We've got this thing going on at the moment. At the weekend, the UK and EU banging together a deal or some sort of deal, whatever they're calling it. New arrangements over trade, over security, agriculture, standards, student exchanges, even perhaps using passport e-gates, which I'm all in favour of. Having been to Spain a few weeks ago and having to queue up with all the rest of the Muppets, while everyone else went down the fast lane. No,
Sorry, let me just apologise for Victor Meldrew over there and his little rant that he's now going on.
I'll give you your baton. Yeah, I'll give you your baton back in a minute, mate. Don't worry about that. This has been labelled as the Brexit reset deal, if you will. Now, as we said, for anyone who's lived and traded through the Brexit saga, you'll know that this is a very emotive subject. And I think this reset will be exactly the same. But I'm not going to get into the leave versus remain arguments around this. As for trading, it's really just important that we look at what the end game might possibly be from this and whether the UK will perhaps be able to negotiate a better trading relationship overall from this point forwards. Personal viewpoints don't matter. All that matters is whether the market likes what's going on with this EU and UK relationship. Will it be better or will it be worse moving forward? It doesn't care how long France gets to go fishing in our waters anymore. It just wants to know, is this going to be better for UK trade? So any improvement on that front between the UK and EU will likely be seen more positively for the pound, and perhaps that's been part of the reason why we've seen the quid a bit more supported of late compared to some of the other currencies. Now, this phase of negotiations may only be the start of things, so we need to keep an eye on the news surrounding this moving forward. We put it all together. You've got the data this week. We've got this trade thing happening. I'm looking at euro sterling at the moment. We know it's been coming down, pretty much for the last couple of months. We're down around this 84 level. Hasn't quite broken through significantly yet, or for any length of time. But if we do start to get more headlines like this, if the data is supportive of the pound this week, then we could be going through that 84 level, maybe heading down to that big fat red line down towards sub 83 even. And that'll be a very, very long-term level to keep an eye on if we get down there.
Yes, very possibly. And as you say, if we do get there, that's certainly one to watch. Oh, God. I mean, the political spin around all of this has just been off the charts, as you would expect. I mean, personally, and I haven't had a chance to go through all the intricacies of what they sort of signed up to, but it just feels like this is incrementally it is positive news, but is it a massive, game changer for the economy? Is it going to be this huge fillip for economic growth on either side of the channel? No, probably not. Is it going to make things marginally easier when you want to go on holiday? Yeah, it probably is. Is it going to make things better for European fishermen? Yeah, it probably is. I just see the market moving past this, if it's even focused on it at all, in very, very short order, to be completely honest with you. And I would like to hope and pray that we can also move past it on this show in very short order and then forget all about it ever again.
Well, now you've said that, I'm going to bring it up every week. I'm going to give you an update bulletin every week on it now. So, no, but you're right. No one's going to be going out and jumping out and buying the pound with the, fist over, hand over fist and filling your buckets up with quids at the moment on this news. But, we talk about sentiment in markets. There's been no end of moaning about how the UK economy has been affected by Brexit. And so if we're getting some sort of slow reverse in just the relationship, I'm not talking about rejoining Europe or anything, then the things are going to get more positive. Things are going to get easier on trade, which potentially has the offset of bringing costs down. So that's something to look at from the inflation aspect. So there's going to be many aspects to look at it for this, but it will be a slow burner, but a burner nonetheless.
Yes, definitely. Sorry, I got very distracted there. President Trump has woken up and decided to have a rant about Beyonce, which is, perfectly rational behaviour for the leader of the free world. But
I was laughing because I expected him to come out ranting about Moody's today, and first thing I saw this morning was him having a rant at Kamala Harris and how much he paid Bruce Springsteen at a election campaign. So if he's on, what was it, Taylor Swift last week and Beyonce this week?
I think whoever the DJ is in the White House is, going to be one of those "you're fired" moments at this rate, I think, given the amount of slagging off he's doing on the internet. Anyway, let's move on from that. I want to talk about volatility for a short while, because it seems like market participants, investors, traders are becoming increasingly convinced that the worst of all of the trade and tariff uncertainty is in the rearview mirror, and that we're now past that point of peak uncertainty when it comes to the issue of trade. And to be honest with you, I think they're probably right to be thinking along those lines. We obviously had that 90-day pause on tariffs between the US and China, which broke this time last week. And as we discussed in the show then, it feels like that pause is probably going to be as good as forever, or at least until a deal is done, because neither side has shown that they want to or have the ability to stomach an effective trade embargo between the world's two largest economies. But at the same time, I would just caution that we have actually only had one deal, quote unquote, actually struck by the United States, and that is, of course, with the United Kingdom. And even that is actually lacking in quite a lot of details, and to the best of my knowledge hasn't actually even been written up formally in a bit of paper that both sides have signed. It's all sort of a verbal agreement at the moment, and that's before you consider what are ultimately more important trade deals with countries like Japan. Progress there seems to have stalled. With the EU, I don't think progress has even started, and also a number of other nations in Southeast Asia. But nevertheless, we have seen volatility come off pretty significantly in reaction to the pause in China tariffs. The VIX is at its lowest levels since the middle of March. The MOVE index, which tracks implied vol in the Treasury complex, that's back under 100. And if you look at various metrics of FX volatility, one I like to use is a proprietary gauge that JP Morgan have put together. That's its lowest level since the 2nd of April, which was, of course, Liberation Day, as Trump liked to call it. So I guess the question for me is whether markets are now potentially being lulled into what could eventually prove to be a bit of a false sense of security. We're obviously only ever one Truth Social post away from the entire outlook being upended again. And may I just stress that will be a Truth Social post about tariffs, not a Truth Social post about various musical artists. I think, whether Trump's listening to Beyonce or Bruce Springsteen is not going to bother the S&P, to be completely honest with you. But I think it is worth just stressing that the trade war isn't over, although it feels like it probably is. We still haven't seen the economic impact of the tariffs that were in place last month. We still haven't seen the impact or potential impact of those tariffs on earnings, and certainly are starting to get a little bit more worried about that after Trump's weekend remarks that Walmart should eat some of the tariffs or eat all of the tariffs. I mean, we've now got the president calling for effectively an earnings recession in the stock of the US's largest retailer, which is not exactly a market positive development, to say the least. And of course, the shape of these final deals is still really not clear. So I'm still bullish when it comes to equities, as long as we remain above this 200-day moving average. I think dips are there to be bought, and I think we will clear this 6,000 mark in the S&P future. But just perhaps warrants a little bit of caution. We've come a long way in a relatively short space of time, and there is still a lot of unknowns and a lot of uncertainty out there.
Yeah, and I think you've got to take this in maybe a couple of aspects. We've had this with every deadline, the market reacting to the news at the first, and then we get the can kick, and everyone calms down, volatility drops, and then a week before the deadline, the market takes a look at what's gone on. And if there's no trade deals happening, then we're going to ramp up again on the volatility. And I think this is no different. It's almost like a slow burning fuse going along at the moment, and we're either going to get to the point where someone's going to lick their fingers and put it out, or it's going to blow up on us. And so long way to go till July still. Deals are still being made. I agree with you. I still think that the market is looking at the end game. It's seen the can get kicked several times. It's seen tariffs start high, get reduced, get reduced, get reduced. So I don't think it really sees any big explosions or implosions, depending on your viewpoint, coming from these trade deals. But we still have some fights going on. As you say, the EU, we're not seemingly close. Japan is something that's brewing as well. They're putting up a stiff fight this time around versus Trump's first time. The Shiba being very strong, and all his members, cabinet being very strong as well, that they're not going to accept these tariffs. And the US hasn't been appreciative of what they did in the first round of trade deals when Trump was first in play. So that's something that's brewing as well. He's got an election, Ishiba, coming up in July. So that's going to be maybe a bit of a focus for all this. So, yeah, lots of things still bubbling under the surface. But volatility as a whole, well, when I saw this subject this morning and then saw what happened in markets this morning with the downgrade, I thought you might have to revise your subject matter there, because Vol obviously has jumped up again today.
Yeah, it has. But I mean, I said this morning with our mutual friend Ryan Paisley. If you're selling stocks or selling treasuries based on what a credit ratings agency has said, then I would. We don't offer advice on this show, but I would strongly recommend that you reassess the way that you're examining financial markets. Let me put it in that slightly diplomatic way. I think we all know at this point that credit ratings agencies are an after the fact event. I mean, Moody's are 14 years after the fact if we compare them to when S&P downgraded the US, and there's not really any new information in what they're imparting. So personally, I would see all of this, the downside in equities, the sell-off in treasuries, and the weakness in the dollar as relatively short-term market gyrations, as opposed to a sort of shift in the longer run trend, which it does seem to be higher in terms of risk assets.
Yeah, I agree with that, and that's my view as well. But as a trader, I've got to look at the risks on both sides. I've got to be objective. What could send this going a bit more? That would be if all the other rating agencies decide that they see the same problems, or the problems have got worse since they last changed their ratings, and they cut their ratings as well, because then that will create a bit of a snowball effect. Because it's not just Moody's then playing catch up, the others are now moving in line with new information. So there's always risks in these markets. You can never say never.
No, absolutely. But you can also never trade off the doom and gloom forever, because you're going to miss the upside catalyst. So don't fall into that trap, which is a very, very easy trap to get into. Anyway, I believe you wanted to talk about volatility as well. So have you rewritten this segment since last night?
No, I haven't. No, I'm a little bit different because, taking the volatility into account, but just how people should look at trading generally. The life of traders really is one of frustration 90% of the time. Take volatility, frustration when volatility is too high, frustration when volatility is too low. We're really in a Goldilocks situation regarding where volatility is, sort of just right. But right now, we're probably in the most Goldilocks situation, volatility scenario we've been in for a long time. We have good vol. It's all interspersed, obviously, with big headline swing risk, and every day is a new challenge of what's going to happen today. Then what's Trump going to say today? Then that sort of thing. However, what I've noticed from a lot of traders over the last few weeks and months is that there's a rush to try and make money as quickly as possible amid this vol. While we have this vol, it's good to be trading, but over trading is not necessarily a good thing. I'm seeing more and more traders trying to do more trades and try and catch every level, every turn in the market. And again, that's not often a good thing. Over trading doesn't mean better trading. So my advice to anyone who feels like they need to grab every trade is that maybe they should look to slow down a bit and be a bit more picky with the levels or trades that you're looking to take. Be respectful of the volatility and how it can suddenly turn a good trade bad or a bad trade good, and be sure you can act quick enough to lessen a loss if that's the case of the former, or take profits in the case of the latter. So if you're making lots of trades intraday and you find your trades are frequently flipping between winners and losers, that's a signal that you need to slow down, maybe sort of widen the price range you're looking to trade over, and be more selective with your trades, because we've got this vol, but you can over-egg the pudding, as they say.
Yes, absolutely. Not sure that phrase will translate to some of our international viewers, but I'm sure the sentiments came across very, very strongly indeed. And I think you're absolutely right. And of course, the other thing that is important to remember is the golden rule, which is that you need to protect your capital. That is the number one aim of the game. And if markets are chopping around all over the place and you're not confident in the trend or what's driving things, then there's absolutely no harm in staying out altogether and waiting for things to become somewhat clearer. No position is a position in itself, as we often say. But sage advice as always, mate.
Thank you, mate. Always a pleasure.
No, you're looking particularly wise as well with that dodgy beard that seems to have materialised over the last few weeks. You've got more hair there than I have on my head.
Well, I was going to say, when I get bored with it, I might shave it off and send it to you, and you can put it on for a bit.
Please do. I refuse to lean forward on this show now, because you can just see how bald I am on top. So
I'll be whistling for a penalty.
Yeah. Oh, dearie me. Oh, dear. I'm going to need a hat before long. Right. Let's move on to our plays of the day. And if we can do a spread trade, long Ryan's beard, short MB's hairline, I think that would probably be a winner this week and for the next decade or so. But
we'll have to get one of those AI programs to sort of merge our faces together.
Oh dear, people will be having nightmares. We'll be getting complaints from viewers. I was unable to sleep last night. Dear me. Right. I think I was going to talk about the dollar, but to be honest, I've completely lost track of things now. Let's try and get this show back on the road somewhat. Obviously, equities extending their gains last week. The S&P up by 5% or so, and as we discussed earlier, I'm remaining bullish there, and a break north of 6,000 is really a question of when rather than if, even though we have come off the boil a little bit as the new trading week gets underway. What I think is interesting, though, as you see on the chart, chart here is that the dollar hasn't really ridden this wave higher, this very crude overlay, which I'll be honest, dual axis charts, a little bit of a chart crime, so do forgive me for that. But this crude overlay suggests that the dollar index should be, well, somewhere nearer 107, 108 than 101 if this relationship between the two still holds. Now, I would argue that this is a sign that we've seen international investors really sitting out this recent rally that we have seen in equities, not quite joining in. And if they decide to do so and up their allocations to the US once again, then maybe there is some upside potential in the dollar as a result. Obviously, the dollar starting the week on the back foot as a result of this ratings downgrade, which I would say the market will probably shrug off in relatively short order. To the upside, we need to crack the 50-day moving average, which comes in around 101.60. But if we do, then this is perhaps one that could start to motor a little bit more. So certainly worth keeping on the radar. Ryan, treasuries. We'll try that again. Ryan, unmute yourself. Treasury.
Yes, I've pushed the button. Calm down, Michael. Calm down. I'm there. I'll get there in the end. I'm looking at the US 10-year notes, and I've coined this phrase today a few times, whether this downgrade stuff is just a storm in a teacup. It's set the bond market on fire a little bit as we record this, and we're approaching a big level in US 10-year notes at the 109 down to 108.29 level. This is a big historical low. It's only been broken 3, maybe 4 times, depending on how many you want to count there. But it hasn't stayed broken for long, and I think that's a key thing to look at here. I don't see any reason why this time should be different. So if we do get down there, I'm potentially eyeing that up for a long.
Good stuff. And I'm going to quote you from earlier on. If anyone is going to do technical analysis on bonds, which is a bit of a grey area, do it on the price. Don't do it on the yield, for God's sake. I mean, it's like when you see people drawing coloured lines all over a chart of the VIX. You just, oh God, it makes you want to tear your eyes out. Anyway, we will leave things there for this week. Thank you very much, as always, to my good friend Ryan Littlestone from Forexflow Live and Forex Analytics for joining us. Thank you also to our producer Kyriakos for bringing things together as brilliantly as always and being the only sensible one out of this trio, I think is probably the best way to put it. Hopefully you have enjoyed the show. If you have, please do drop a like on the video. Leave a comment as well. Let us know how you're trading the markets, whether you think the the downgrade is just a storm in a teacup, or whether you think it's a bigger issue. If there's been a default, then all bets are off, I think.
It's me in the cup.
A little bit of a Freudian slip, that one. The teacup would have been smashed to bits at that stage, I think. Oh dear. Let's wrap it up there. Thanks as always for joining us. We'll be back this time next week. Goodbye for now.